Hello everyone, today I'm going over the second part of properties of stock options. Last time we've talked about the lower boundaries of American options. This time I'm gonna discuss the lower boundaries of European options. So with European options, mainly the exercise can only happen at expiry date capital T. In this case, the price of a call option of a European call option at any point in time should be greater than or equal to ST minus the present value of the strike price X. For the put option, the European put option, it should be greater than or equal to the present value of the strike price minus ST. And the reason here why we're using the present value of X instead of X, like with the American option, the exercise can happen at any point in time. That's why we use X. While for the European option, the exercise can only happen here. So when we are here, let's say at this point in time, T or lowercase t, here we can talk about the present value of X because we know that the exercise can only happen here at expiry date capital T. Now, in order for you to prove that any of the boundaries, whether it's a lower boundary or an upper boundary, that such a boundary exists, you can always work backward. You can assume that the opposite is true, and then you will show that the opposite cannot hold because it's going to create, let's say, an arbitrage opportunity. So here I will start with the European call option. We assume that C is less than S minus the present value of the strike price X. So this is what we have initially. Because we know that C should be greater than or equal to ST minus the present value of X. In this case, because I have the following, I can take here a long position in C and a short position here. So what I need to do, I need to short X, short 1 unit of the stock, buy one call, here I have long C, and then lend X at the risk-free rate. This means invest in X or K risk-free rate bonds with maturity at time capital T. So here mainly, when you have minus X, and this is short minus X, it's equivalent to long X. This means that in this case, it's lend X or invest or buy the risk-free rate bonds, which will have, in this case, a face value of X or K at capital T. So X or K, in this case, is the face value of that risk-free bond. So I know that when I invest here, like this third investment, at capital T will grow exactly to X or K. So now in this case, let's see what will happen with my portfolio. So this is what I have at time T equals 0. I have a long position in the call, so minus C, I'm paying the premium. I have a short position in the stock, so plus S, and I have a long position in the bonds. And this is just to remind you because there I had short minus X, which means long X. In case I had short X, in this case, I need to borrow at the risk-free rate instead of investing. So the portfolio value at time T equals 0 is S minus C minus X E minus RT. We've assumed at the beginning that this value is greater than 0. This is the assumption that we've made at the beginning. Now, at any time, like at expiry, because this is a European option, it can be only exercised at expiry. At expiry, I have two cases. The first case, if the option expires in the money. In this case, I will have S greater than X. This is this case. The first case, this one here, is out of the money. So with out of the money, I have S less than X. So now, the short stock position at any point in time, whatever the price is, I will have the value minus ST because I have a short position. Now for the long call, if the call expires out of the money, the value of the call is gonna be 0. If the call is in the money, I'm gonna exercise the call and receive ST minus X. Now, investing in the bonds, in the risk-free bonds, I will have at maturity the face value of the bond, which is X. So this value X here is fixed. So now, if I go to the first situation, if the call expires out of the money, I will have X minus ST. By definition here, this is the condition that I will have when S is less than X. S is less than X, this means that X minus S is gonna be greater than 0. Now, if there's exercise, if the option expires in the money, in this case, I add everything up. I will have minus ST plus ST, they will cancel out. Minus X plus X, they will cancel out. And I will have 0. So as you can see, this portfolio has either a positive cash flow in the future or 0. This is the worst case. So this asset may yield me with a positive return in the future. However, that investment doesn't have a negative cash flow at time t equals 0 because this value here is also positive. So now if I go back to check the arbitrage conditions, you can see that there is no asset that has a positive payoff later and a non-negative payoff now. So this condition will violate the no arbitrage assumption. This is the definition of an arbitrage assumption. What we are seeing here, that in this case, if for any reason we have C less than S minus the present value of X, an arbitrage opportunity will arise, because in this case the value of the portfolio we will have a positive cash flow at time t equals 0, and in the future we may also have another positive cash flow. So because this violates the no arbitrage assumption, we can say that C can never be less than, so here if I go back, C can never be less than S minus the present value of X E minus RT, the present value of X. So for that reason, this inequality should always hold. I can say that CT should be greater than or equal to ST minus the present value of X. Now here we move to a numerical example. So let's assume that S equals 45, X is equal to 44, and the risk-free interest rate is such that ERT equals 1.1. So the future value of $1 is 1.1, which means that E to the power minus RT, the present value factor, is 1 divided by 1.11. And in this example, we have C equals to $3. So let's see what we can do in this case. In this case, as you can see, when I talk about xe minus rt, xe minus rt is equal to 44 times e minus rt, which is 1 divided by 1.1. So the present value of x is $40. In this case, you have c is $3. S minus the present value of x is equal to 45 minus 40 equal to 5. So what I have in this case, I have a violation of the lower boundary condition. So as you can see, I have this case, c is less than s minus the present value of x. So in this case, let's follow the following arbitrage strategy. I will short the stock. So this is at t equals 0. I will short S. So I will have a cash outflow of plus $45. I will be receiving that amount. I will use that amount to take a long position in the call. So here I will have minus C, which is minus $3. And here I will invest in the risk-free bonds. I will invest in a bond with a face value of x. So x is the value that I will receive at maturity. So here I will have minus $40. So the cash flow at time t equals 0 is 45 minus 3 minus 40. This is plus $2. Now, what will happen in the future? I have two cases. So this is at expiry date. If ST is less than X, the call will expire out of the money. Now, whatever the value of the stock is in the future, I will have this as ST. The call is not exercised, so I will have 0. Here I will have the future value of this investment is the face value, which is $44. This is X. So here I will have this is minus ST because I need to cover my short position. I will have 44 minus ST. However, by definition, ST is less than 44, so this value here is greater than 0. Here I will have ST greater than, let's say, or equal to X, so I will have minus ST. The call is going to be exercised in this case. The payoff is ST minus X. Here I will have 44. 44 minus 44, they will cancel out, and minus ST and plus ST, they will cancel out. So as you can see, with this arbitrage opportunity, I can catch this cash inflow of $2 at time t equals 0, and in the future, I may have no other cash flows, and in case there's any cash flow, it's gonna be another cash inflow. So let's say, for example, if ST is equal, if the stock price goes down, it's now, let's say, 35. In this case, I will have another cash flow of 44 minus 35. I will have another cash flow of $9 by expiry date. So such opportunity, if it exists in the market, all the investors will follow that same strategy in order to grab that easy money, that risk-free profit. And as you can see here from this example, theoretically speaking, if no margin exists, no margin requirements exist, you can finance your long positions with that short position. This means that you do not even need to have an initial investment in order to generate that risk-free profit. Now, upper boundaries of options. First of all, the call premium cannot exceed the stock price. So think about it. And this applies whether it's an American or European option. So the option gives you the right to buy at X. And X is mainly a value that is greater than or equal to 0. So mainly the lowest price at which you can buy the stock is 0. So in this case, you will never buy for the call option more than you would buy to buy the stock itself. So if the American call at any point in time we're selling for more than the stock price, you can form the following arbitrage portfolio. You can sell the call and buy the stock. In this case, you short the call, you will get plus C. You will take a long position in the stock, you will have a cash outflow of minus S. The portfolio value at time t equals 0 is C minus S. It's greater than 0. Now, in the future, there are two situations. Either the option is not exercised or the option is exercised. If the call is not exercised, we will receive 0. S will have a value of ST. So in case there's no exercise, the value of the portfolio is S, which is greater than 0. Now, in case the option is exercised, and here because this is a short call, and this is what you should do whenever you have a short position in an option. Think about what will the party with the long position do. So when you have S greater than X, which means that the call is in the money, in this case, it's profitable to the party with the long position to exercise. So the party with the long position will exercise, and you will have the following payoff or the following cash flow. However, because it's a short position, I need to multiply by minus 1. So this will become minus S plus X, or X minus S. So this is what I have here, X minus ST. The long position in the stock will be ST minus ST plus ST, they will cancel out, and then I will end up with X, the strike price, which is greater than 0. So as you can see, with this strategy, this is an arbitrage opportunity. I will have a cash flow at time t equals 0, and in the future I will also have a positive cash flow no matter what the stock price is. So for that reason, I can say that the call premium is always less than that of the stock price. Now for the put options, with the put options here, I need to differentiate between the American and European put. For the American put, PT is less than or equal to X, less than or equal to the strike price. So with the put, you have the right to sell at X. Let's say that X equals $100. You can sell the share for $100 per share. Now, the lowest price at which you will realize your maximum payoff is ST equals 0. So when ST is equal to 0, your maximum payoff is equal to 100 minus 0 equals 100. So in this case, the maximum profit that you can make is $100, is mainly X. And here I'm this is as payoff, like the maximum payoff can be $100. So now when I consider the premium that I should pay to have an exposure to get that, like a possibility to get that maximum payoff of 100, I should never pay more than 100 to buy such put option, because the maximum payoff is 100. So I will never pay a price for the put or PT which is greater than 100. I will never do that because I can never end up with a profit because the maximum payoff is 100, and even with the maximum payoff I will end up losing money. So in this case, if the American put option were selling for more than the strike price, we can form the following arbitrage portfolio. We can sell the put and long X and long the bonds, invest in the bonds. In the following example here, we have the situation with a European option. And the difference between the European and the American option is that with the European, I can only exercise at maturity, at expiry date, capital T. So in this case, if I short the put and invest in the bonds with a face value of X, at time T equals 0, I will receive P, the premium of the put, and I will use part of that premium, part of that collected premium in order to invest in the risk-free asset. So I will have minus X into e to the power minus RT. The cash flow at time t equals 0 is greater than 0. This is a cash inflow. Now, what will happen in the future? Two cases. First, the option is out of the money, it's not exercised. And because this is a put option, this means that S is greater than X. So if the price is greater than the strike price, here there's no exercise, because for the party with the long position, X minus S is going to be negative. So the party with the long position will decide not to exercise, and therefore we will have here 0. In case the option is in the money, the option is exercised, the party with the long position will receive X minus S. So here, because S is less than X, X minus S is positive. However, because here we have a short position in the put, we need to multiply by minus 1. So this becomes S minus X. So now, ST minus X plus X, those two values, they will cancel out. So to sum, in case the option is not exercised, our cash flow, the cash flow of the portfolio is X, which is greater than 0. In case there's exercise, the cash flow is S, which is greater than 0. So once again, here I have an arbitrage, a clear arbitrage opportunity. Such situation cannot arise in the market. So I can say that PT can never be greater than the strike price or the present value of the strike price. So here, in this chapter, like we are mainly talking about the properties, later on as the next step, we will move to the valuation of call and put options. However, so far we did determine that the value should be between an upper boundary and a lower boundary. So for the European or American call options, their upper boundary is S0, their lower boundary is S0 minus the maximum of S0 minus X E minus RT and 0. For the put option, the value has an upper boundary of either the strike price X if it's an American, or X, the present value of X if it's European put option. And in this case, the value should be greater than the maximum of X minus 0 and 0 if it's an American put. If it's European put, it's minus the maximum of the present value of X minus S0 and 0. This is going to be the lower boundary. Now, what should be the impact of dividends on lower boundaries of options? Now, mainly when dividends are paid, the stock price will decrease by the value of the dividend. And this is mainly bad news for call options holders, but it's good news for put options holders, especially when the value of the dividend is significant. So in this case, when I add the dividend to the model, and if you remember here, I mean by capital D, this is the present value of all dividends paid between t equals 0 and the expiry date, capital T. So in this case, I will have the call is greater than or equal the maximum of S0 minus the present value of all dividends minus the present value of X and 0. For the put option, the put option should be greater than or equal to the maximum of the dividend D, the present value of all dividends D, plus the present value of all of the strike price X minus S0 and 0. Okay, now I move to an important relationship between put values, options values, and the asset value. So this can be considered as an introduction to the valuation of options. And here we're going to consider the relationship between the price of European call, European put on a non-dividend paying stock. Later on, we will move to American call, American options like American calls and American puts on non-dividend and dividend paying stocks. So now the assumptions that we have here, there are no transaction costs, there are no taxes. Investors are able to borrow and lend money at the same risk-free rate. Now, put call parity gives the following relation between the price of a put and a call. S0 plus P0 is equal to the present value of X plus C0. Now, let's prove why this is the case, why the put call parity will hold. So mainly we have the following: S0 plus P0 is equal to C0 plus the present value of X. I will say that those are two separate portfolios. I have first portfolio A, and this is portfolio B. If I can prove that the future cash flows of those two portfolios are equal, this means that A and B should be equal at time t equals 0. And this is the law of one price. When you have two assets or two portfolios that are generating the same future cash flows, those two assets or those two portfolios, they should have the same value or the same price. So I will start with A. With A, I have the following: long stock and long put. So now, at expiry, because remember here I'm talking about European options, at expiry I have either the option is gonna expire out of the money or in the money. In this case, I will take two cases. I will take the case where S is less than X and the case where S is greater than or equal to X. So now, long stock, the stock will have a value of ST. This is, by the way, this is greater than or equal to X. So here we are talking about the expiry date, capital T. Now, the long put, in case S is less than X, the put is in the money. In this case, we're gonna exercise the put option. We're gonna receive X minus ST. The second case, if S is greater than or equal to X, the option is out of the money and there's no exercise. So for portfolio A, if the stock price is below the strike price, we will have the value of the portfolio is X. if the stock price is greater than X, the value of the portfolio is ST. Now I move to the second portfolio, B. With B, I have the following. I have a long call and I have a long position in the bonds. So here I'm investing in risk-free bonds with a face value of X. So at maturity, I will receive X. So in this case, if S is less than X, the long call here is out of the money. So we're not gonna exercise the call. Here we will have 0. X is the value because at maturity or at the expiry date, I will be receiving the face value of the bond, which is X. Now, the second case, if S is greater than or equal X. In this case, the call option is in the money. I'm gonna exercise my call option and I will get ST minus X. And here I will be receiving the face value of the bond X. So for portfolio B, I will end up with either a value X if the stock is less than X, or a value ST because minus X and plus X, they will cancel out. And as you can see, I will have exactly the same cash flows. So because portfolio A and portfolio B, they have exactly the same value or the same future cash flows, I can say that A is equal to B at time t equals 0. So that's why the put call parity will hold. Now, as a summary for the put call parity for American and European options for non-dividend paying stocks and on dividend paying stocks. This is a summary of all the cases. Of course, we mainly covered this case, which is C, the call premium plus the present value of the strike price should be equal to the stock price plus the put option. So this is the put call parity for non-dividend paying stocks for European options. Now, the difference with American options is that American options can be exercised before we get to the expiry date. So this is t equals 0, this is the expiry date. With the European option, the exercise can only happen here. So that's why here we were using the present value of X. Because here we need, let's say, to invest or to borrow at the risk-free rate. So here we know that the value will become X once we get to the expiry date. However, with the American option, I can mainly exercise here. So once I'm exercising here, I will need the full value of X and not the present value. For that reason, American options, we won't have an equality for the put call parity. However, I will have this following case. And as you're gonna see, like I can move from the European option to the American option because here from the European option, I can write the following. I can write that C minus P is equal to S minus the present value of X. So the stock price minus the present value of the strike price should be equal to the difference between the call premium and the put premium. So if you want, this case here that I have here, this part, this is for the European option. So this part mainly, this is when we exercise at expiry. Now, the other case that I have is when I immediately exercise the option. Because with the American option, I can exercise at any point in time. So if I exercise at time t equals 0, I will have here minus x. So here it's like c minus p will be between two values of s0 minus either x in case I exercise at time t equals 0, and s0 minus the present value of x if I exercise exactly at the expiry date. Now when I add dividends into the mix, the adjustment that I need to make in this case, and here by the way it can be written in different ways, but like remember that d, which is the present value of all dividends or of all dividends that are to be paid before the expiry date or until the expiry date, so the value of d will reduce mainly the value of s0. So here I can write it either as c plus x e minus rt is equal to s0 minus d plus p, or I can take the d to this side, so it becomes c plus d plus the present value of x should be equal to the stock price plus the put premium. So now once again I can transform this to the following. I can write it as c minus p is equal to s0 minus d minus x e minus rt. So here once again with the American options I need to add d into the mix, the present value of all future dividends. Now in the following I will go over the early exercise conditions for different options, and here I'm gonna consider different cases, because mainly I may have an American call on a non-dividend paying stock, and I have the case of an American call on a dividend paying stock, and I'll also have the same for American put options, which can be on either a non-dividend paying stock or a dividend paying stock. We will see under each condition what will change, whether it may be optimal to exercise early. So mainly there's some chance that an American option will be exercised early. The only exception for an early exercise is the American call option on a non-dividend paying stock. And the reason why we will never exercise early an American call on a non-dividend paying stock is that C in this case is always greater than S minus X. So the call premium is always greater than the payoff. So if I exercise, I will get S minus X. I will get only the payoff. However, if I sell the call, I will receive a value that's greater than S minus X. So for you as an investor, when you hold a long position in the call on a non-dividend paying stock, you will never exercise your option early unless you did reach the expiry date and the option is in the money. Otherwise, if you are at any point in time prior to the expiry date, it's more profitable for you to sell the call option to another investor. So now why we have an exception with this American call? So with American call on a non-dividend paying stock will never be exercised early for the following reasons. First, there's no income is sacrificed. So here, when you want to buy, when you want to exercise, it's like you are going to pay X. You need to pay the strike price X. When you go and talk about the put option and you exercise, you're gonna receive X. So mainly when you delay exercising the call, when you delay exercising the call, you delay the payment of the strike price. So instead of paying this value minus X, you are delaying this payment. And over time, you will end up receiving interest on that value. So let's say that you have this value X that's ready. Whenever you want to buy the call, you are ready to pay X dollars for the stocks. In this case, when you are delaying this payment, this means that you will be receiving interest on X. And here I'm saying that there's no income that is sacrificed because remember that here, like, this call does not pay any dividends. Because if this call was paying, like if the stock is paying you dividends, you may decide to buy the stock earlier in order to benefit from those dividends. In this case, no income is sacrificed and you are delaying the payment of the strike price. Finally, holding the call provides insurance against stock price falling below the strike price. So it's like the call option has a built-in put. Because if I go back to the put call parity, I know that C is equal to S minus the present value of X plus the put premium. So if I'm exercising early, I'm giving away also this insurance against the stock price falling below the strike price. So I'm giving away that put option for free. Now I will provide later on just a quick example because mainly those parts are included in your project. You need to provide a proof. That's why I cannot explain further, but like I will give you, a lead on how to get there, how to prove that the American call option on a non-dividend paying stock should never be exercised. While for all the other options types, I mean for the American call option on a dividend paying stock and for the American put, whether on a non-dividend paying stock or on a dividend paying stock, there are conditions for early exercise. So investors may think that it's better for them to exercise the option early. Now, the early exercise condition for an American put on a non-dividend paying stock. So those are the conditions on when it may be optimal to exercise an American put early. Usually this is the case when the stock price is too low relative to the strike price. So for example, let's say X is 100. Currently ST is $1. So in this case, the stock price has like limited room to go. So the stock price can only drop to zero. So any potential additional decrease in the stock price is to go from 1 to 0. The put option in this case, as you can see, is deep in the money. You have $99. This is the intrinsic value of the option. Now, when you exercise the put, you accelerate the payment of the strike price because you will be receiving X. You will be receiving this $100. And this $100 can be invested till expiry date T. So here you can think about it this way. So now, if you exercise, your payoff is gonna be $99. If you wait, let's say, for an additional year, you're gonna only make, like, your maximum potential profit is gonna be $100. However, if you exercise early and invest the proceeds, you may end up with a value that's greater than $100. if you invest the proceeds from exercising early the put option from now till the end of the year, till this expiry date. So this is mainly the exercise condition of an American put option. And mainly here, points 1 and 2 are in a way similar, because when the stock price is too low relative to the strike price, it already means that the put option is deep in the money. So those two conditions, they are similar. And if you want, I can merge them in one condition. Now, what happens when I have options on a dividend paying stock? What will change in this case? So an American call option on a stock that pays dividends may be exercised prior to expiry. And in this case, if it's optimal to exercise the option, the call option, the best time to exercise it should be just before the ex-dividend day. So now, when we are exercising early a call option, we are throwing away the downside protection, which is the put option. And exercising early a call option will accelerate the payment of the strike price, causing a loss in interest. Because when I exercise the call, I need to pay X. So when I pay that amount X, it means I can no longer invest that amount and earn the risk-free rate on that value, on that strike price. Now, if the dividend is large enough to offset those two losses, we should exercise early the call. So if the value of the dividend is greater than the put value and the loss in interest, on X, in this case, it's better to exercise early. However, in this case, I need to wait till just before the ex-dividend day. So just before the ex-dividend day, I exercise, I'll get the stock. This means I will be able to get the dividend. I will be able to capture that dividend. So now the best time to exercise is just before the ex-dividend day, as this is the most we can postpone the payment and still claim the dividend on the stock after exercise. So this is the condition of early exercise for a call option on a dividend paying stock. Finally, we have the case of American put on a dividend paying stock. So now it might be optimal to exercise such a put option prior to expiry. However, dividends will tend to delay exercise of an American put. So a future dividend will cause the stock price to decrease, which will increase the value of the put. Therefore, it might be optimal to wait for this drop before early exercise, meanwhile pocketing the dividends. So with American put options on a dividend paying stocks, if I want to exercise early, I may wait till the dividend is paid before I exercise. So there may be such a delay, but it doesn't mean that always we will delay till the dividend is paid, because let's say that the dividend is going to be paid. This is the expiry after 12 months. So we are here at time t equals 0. And the next dividend to be paid is here in month 3. In this case, it may be optimal to exercise now the option, or here, because although this dividend, I can capture that dividend, but that dividend, let's say, has a low value, or let's say that dividend is, let's say, relative to the stock price or relative to the strike price, let's say 1 or 2 cents, while I'm talking about a strike price of $100. So it won't make that a huge difference.